A full trading plan that works in any market, any time frame, and any time. This is what I'll show you in this full course. You'll understand that all ICT concepts are based on three main concepts, and I'll show you how to create your own trading plan based on those three concepts. Some of the things that I'll go over and explain in this video include liquidity, market structure, PD arrays, top-down analysis, time frame alignment, high reward to risk, entry confirmation, trade management, and finishing up the video with examples. Make sure to like and share this video with your friends. Let's get into it. The first thing that we're going to cover is the most important ICT concepts. We know that ICT concepts, there are a lot of them. There are ones that are less important. There are ones that are very important to me. There are a lot of ICT concepts that I learned. I spent a lot of time learning, and I put the time and efforts, but then at the end, I'm not using them that much. Maybe not at all, right? So I don't want you to also do the same and spend a lot of time to learn something that, even though it looks good, it looks like, oh, it's going to be beneficial, but at the end, you're not going to find any use of it. The most important ICT concepts are four, and that's only my opinion, but you're going to see that a lot of people are actually agreeing with this. So the first thing and the most important concepts of all time, not only in ICT concepts, but in trading as a whole, okay, which is liquidity, because without liquidity, nothing moves. Without liquidity, we're not going to have manipulation. Without liquidity, we're not going to have expansion. So the market moves by taking liquidity. And even, they're going to look at PD arrays, which is the second most important ICT concepts. But even PD arrays, when looking at the lower time frame, it's going to be a liquidity at the end, okay? But ICT put it in a way that you don't see it on the same time frame. So PD arrays, again, are nothing but liquidity on the lower time frame. So a fair value gap, for example, if you switch to a lower time frame, and I've talked about this before, it's nothing but what? A liquidity. Market structure shift. You got to understand market structure. So you need to understand breakout structure. You need to understand a market structure shift. You need to understand what a change in state delivery is. So you need to have an idea about, the market structure. And there is a full video, a full course that I've done, maybe 2 videos before this about the market structure. It's a full course about strong highs, strong lows, and also the market structure shift and the breakout structure. So you also need to understand this in order to continue the video, and also time. So you got to understand what time mostly the manipulation is. You can actually use the quarterly theory in this as a confluence. You need to understand what kill zones are. You need to understand the weekly profiles, the daily profiles, all of those things I explained briefly in my videos. But if you want to have an idea about all of those concepts in one video, it's going to be this one. So this is an ultimate beginner's guide to ICT or SMC concepts. It's a full course, 30-minute, a video for beginners especially. So if you have no idea about those concepts, then you need to watch this video first, then come back and continue watching this video. Now you started learning ICT concepts and you know all of the basics, but something that is stopping you from being a successful trader. What is it? It's hopping from a strategy to another, from a setup to another, thinking that there is something better than the other, and thinking that after failing one trade in your setup, the setup that you promise yourself to stick with it and trade based on it, then you see 1, 2, 3 losing trades and you switch to another strategy. That's one of the mistakes that I've been doing, and probably this is a mistake that you're doing now, right? And it's stopping you from being a profitable trader. You go on YouTube and you see that people are coming with different and new strategies every day, and you think that, okay, I need to take my strategy to another level or learn something new. But in reality, you will notice that there are 3 concepts that are behind all ICT strategies. Now go to Twitter and you'll see that people are calling this as their setup. People are calling this as a new setup that has a higher win rate. But in reality, what does it depend on? 3 concepts. And let me prove this to you, okay? So this is the proof: liquidity, market structure, and PD arrays. And that's why I said those concepts are really important to understand. So 3 concepts behind all strategies. When looking at, let's say, some people say, oh, we have the holy grail and we are trading turtle soup, and there are people who are selling courses for thousands of dollars and it's all basic. But in reality, what is turtle soup, right? When looking at those 3 concepts here, 3 main concepts in ICT: And again, those are the three most important concepts in ICT. So liquidity, when we're looking at liquidity, when trading turtle soup, what specific liquidity level we're taking a look at? Actually any liquidity level. And for the market structure shift, in order to enter based on the turtle soup, what do we need to enter? So some people just enter based on luck. The actual entry is actually a change of state delivery. So we're going to wait for a change of state delivery after taking that specific liquidity level. And then we enter without the need of any PD array. So none, no PD array needed. That's a turtle soup entry. Now let's say that there are some people who are coming with external to internal. So let's say, for example, taking previous day high or previous day low, then returning to the internal structure, right? So taking, let's say prices coming lower, taking the previous day low, going to internal here. How do we deal with this? What is this based on? So when talking about liquidity, previous day low, then for the market structure, what are we looking exactly that's going to give us an indication that the market is switching the direction, or that's an indication that, okay, we're actually flipping now. It's a market structure shift. So we're looking for a market structure shift in order to have an indication that, okay, we might be going internal now. And what PD array we're using, you could use fair value gap. So that's what the external to internal setup is. Now, 2022 mentorship model, that's one of the most famous and popular setups, right? What is it based on? Any liquidity level, market structure shift, we need it, and then a fair value gap. That's simply what a 2022 mentorship model is. Now, I'm not saying, oh, look at those three things only. That's why we need to perform top-down analysis, and that's what this video is about. It's about a whole strategy that is based on top-down analysis, based on liquidity, based on market structure, based on PD arrays. Now, my model that I published about, 2 months ago, and it's the first video that I posted on this channel. That's what I was trading, 2 years ago, right? So my model, which is the agent sweep, we're looking at an agent sweep on the London session. What is this based on? Liquidity, we're looking for the agent high or low. So you see how all of those different setups, they have the same logic. It's a liquidity level, it's a market structure, and it's a PD array to enter. So liquidity level, that's the first thing to look for. Or we could look for a PD array right here. So not just a liquidity level, but a fair value gap, a filling of a fair value gap, because that's a liquidity level at the end of the lower time frame. We look also for the market structure. So my agent sweep, we look for agent high or low taken. We look for a change in state delivery, and we don't use any PD array to enter after. So you could actually do the same. Wait for a market structure shift and then enter of a fair value gap. That's another setup that, I could, based on this table right here and based on more data that I am able to actually get from this table, I could make, hundreds of videos, and they're going to do nothing but confuse you. That's why I'm showing you this and just telling you that they're all the same based on those three main concepts right here: liquidity, market structure, and PD arrays. Now note that this is a trading plan and not a strategy. A strategy, when I'm coming to you and telling you, okay, I have a strategy for you, it means that, okay, look for this, enter in this, and then take profit here, right? But a trading plan will tell you what the framework to look at. So determining the bias, determining the trade to take, determining the take profit, the trade management as also break even, stop loss, invalidation, all of those things. Based on the trading plan, you could actually create a strategy. But what people do is they give you a strategy that works in specific time, specific context, and then leave everything else for you. And you're going to be struggling. That's why I'm giving you this trading plan, which is more important than just a specific strategy. It's a 4-step plan to follow in all strategies. So any ICT strategy that you see is going to depend on this trading plan that I'm going to show you, or those 4 steps. So this video could be also about how to make a trading plan. After understanding all ICT concepts, that's how you make your plan. Top-down analysis, and why is it important? Why in this setup, and why in a lot of the strategies that you're seeing, when there is no top-down analysis, it doesn't really work. And even on my agent sweep, what I do is we always look at the higher time frame and we look for the context or the framework that we are at, right? So we're not simply looking for any sweep of a high or low of the agent session and then entering. No, we need to still perform some top-down analysis. So why is it important? Consider this price action right here. What do we see? Price is expanding, ranging, expanding. Coming lower, there was some range here, expanding from here. Ranging, expanding, and then ranging here, expanding, and then ranging. If you are not performing top-down analysis, what's going to happen is that you might be trading those ranges and then saying, oh my God, this is a bad day. And then this happened, it stopped you out, and then price goes here. And you're not entering this. You were entering on this range. Why? So let's say you lost 2 times here, and the market only wants you to give up, not trade, and then the real trade is going to happen. And the same thing here. So let's say you enter here and you're like, okay, why is this market ranging? Why, when I'm always out of the market, I'm not trading, it's expanding. But then when I'm in the market, it's ranging. What's the matter here? It's not about you. It's about your technicals. It's not about the psychology. So trading in this, because you're not actually performing the top-down analysis. And why? If you want to catch this high here, not catch the high, but catch the, the trade after it, for example, or trade this low was created here, price going up, you could enter from here in the lower time frame. How do we do that? We're going to be looking at the higher time frame. So if I'm looking at only at the 1 minute and I only see this price ranging, that's because price did not reach a 15-minute or an hourly or a 4-hour POI. So the expansion is going to happen when we reach a higher time frame POI. And again, higher time frame is relative. So higher time frame is not only like hourly chart, because hourly chart, if I'm talking about 4-hour chart, it's not higher time frame. Then higher time frame is gonna be, for example, weekly or daily. If I'm looking at this chart right here as, let's say, a 1-hour chart, then I want to see weekly or daily POIs or daily point of interest, right? At this level, that's where the expansion is going to happen on your lower time frame. That's where the expansion is going to happen. Those ranging are going to be happening when I'm just looking at the hourly or the 4-hour chart, right? Just by itself. We're going to see that it's ranging because it did not reach any higher time frame POI. So that's why top-down analysis is very important, because otherwise, if you don't use it, you're going to be trapped in a consolidation and ranging market. Price will only expand when it's reaching higher time frame POI. So by understanding the top-down analysis, now we understand the secret to high reward to risk. So a lot of people ask, and a lot of people see people getting high reward to risk trades. What's the catch here? It's nothing but what? Performing top-down analysis. And what's the catch inside or in details? It's catching a small move in the higher time frame with an entry in the lower time frame. So let's say I'm looking at a 4-hour time frame and I'm only catching, let's say, one expansion candle on the 4-hour time frame, but then I'm entering on the 1-minute time frame. Imagine if I was able to actually spot that precise entry and accurate one, I could get 10 RR, right? Or 20 RR if that candle is a big expansion. Or if I'm catching, let's say, an internal to external move on the 4-hour and I'm entering on the 5 minutes or the 1 minute, it's going to be harder for sure. So it takes more experience. It's not easy to get high reward to risk. However, this is the way. Practice this, entering on the lower time frame and catching a higher time frame move. That's how you get those high reward to risk. Without time frame alignment, we cannot perform a top-down analysis. So we need to have a clear time frame alignment. This way, we can actually, perform the top-down analysis perfectly. And we need 3 time frames, 2 or 3. Now there are 2 approaches or 2 options that you have. Either take 3 time frames or 2 time frames, and you're gonna know the difference in the next slides. But those are the time frames, and those are flexible time frames. So don't feel that you need to actually follow those exactly the same. You could actually play with it and skip one time frame or another, or look for a closer time frame to the 1 hour, for example. 30 minutes, you could do this and change this. So feel free to do your adjustment, but those are the time frames that I suggest, right? So let's imagine that I'm taking my higher time frame as the monthly. I would skip one time frame, go to the daily as my intermediate time frame, and then I'll skip one and go for my lower time frame, which is going to be the hourly. So you see, one suggestion here is starting from the monthly, go into the daily, go into the hourly. Now another one, and this is the one that I also use, which is the weekly, right, as my high time frame. Then I'll go to 4 hours, so I'll skip the daily, I'll go to 4 hour, and then I'll skip the hourly, I'll go to 15 minutes. That's one time frame alignment suggestion that I'm giving it to you. Feel free to do some adjustment, but this is the one that I use. So 4 hour, I'll skip 1 hour and I'll go to 15 minutes. I'll skip the 5 minute and I'll go to 1 minute. So that's another time frame alignment that I suggest. This is for more as a scalping, because your entry is going to be on the 1 minute. This is like, on the middle. If you wanted to enter based on some swing trades, you could follow this monthly to 1 hour and then daily in between. Or you could skip the third time frame, and that's what I'm going to explain later. So it could actually only depend on monthly and daily. Weekly 4 hour, 4 hour 15 minutes. Those are also some valid time frames. So we're going to understand later when to use the higher time frame and when we can actually stop with the intermediate time frame and skip the lower time frame or stick with the lower time frame. We're going to explain this in the next slide. The first step in our 4 steps protocol, the first step is looking at the framework, which is going to be on the higher time frame. So whatever is happening in the lower time frame, it needs to be aligning with the higher time frame. I need to have a clear framework on what is happening on that time frame. What does framework mean? It means that do we have a move of external to internal or internal to internal? I need to understand that, because the understanding of this is going to tell me where price is going to. So if I'm having an external to internal move, what does that mean? It means that we're actually taking a high, going lower to a fair value gap, and we might either disrespect that fair value gap or expand from that fair value gap going higher. Now, what does an internal to external mean? So the opposite here, internal to external. It means that we are most likely reacting off a fair value gap and we're aiming for the high as our target. So we're having something like this. So price is coming to a fair value gap, taking that high again. So that's the context, or that's the framework that we're looking at. Is it an internal to external or external to internal? And this, just by looking at this question, is going to answer a lot of the questions below. So another question is what PD array we're reacting off, what PD array we're targeting, and then what is the invalidation? So what's something that could happen that I'll forget about this trade idea? So on the higher time frame, if I see something like this and we have fair value gap here, but instead of this fair value gap holding, this fair value gap was actually closed below. So that's one reason of invalidation. So if we see a closure or displacement above or below a fair value gap, or a closure with a displacement above or below an old higher low, then that's also an invalidation. So the main thing is understanding the internal to external, knowing that internal are fair value gaps and external are highs and lows. That's gonna actually give you a clear framework. And this is one of the most important concepts that you need to understand in ICT concepts. And the whole market, moves in this way, because we understand that price only moves from internal to external, or the opposite, external to internal. And we know that price does two things, only two things in the market. And you see that this cycle repeats over and over. And what are those? Price coming to a fair value gap, rebalancing fair value gaps, and taking highs and lows as a liquidity level. So that's the first step that we need to do. And don't worry, we're going to go over some examples at the end, and I'll show you a step-by-step how to actually look at those frameworks. So let's say we're having this higher time frame POI. So let's say a fair value gap, and we're breaking above this with so this is a breaker structure here. We're breaking above with a displacement. We're coming lower, and I don't want to trade the external to internal. So just say for any reason, I did not see a setup here. And now we're having this high as an external, and we're having what? A move of internal to external. But regardless of all this, a higher time frame POI. So let's say this is your higher time frame POI. As price come into that higher time frame POI, you have a high probability that your bias would be the same. So let's say it's a bullish POI on the higher time frame. It means we are having a bullish bias inside of here. Most of the time, I would say 70% of the time, as we are inside of a bullish fair value gap on the monthly time frame, on the lower time frame, we are bullish. A bearish POI, and that's, we're keeping it simple here, very simple. So how to establish a bias? Look for a POI on the higher time frame and trade based on that. If it's a bullish fair value gap, then we are bullish. If it's a bearish fair value gap, then we are bearish in the lower time frame. So same thing here. You see bullish POI, bullish bias, bearish POI, bearish bias. Targeting what in this case? This high right here, which is the external, because we're moving off internal to external. Now into the intermediate time frame. So we're not gonna be entering immediately as price comes to that higher time frame. I want to see some confirmation or some indication that, okay, the bias is right. There is indication that there is something that the price action is doing that is giving us a hint that, okay, price is willing to move in that direction, the same as the higher time frame POI. So as price is coming inside that POI in kill zones, what I want to see is this: price taking a liquidity level and breaking that high in between. What is that? That's a market section shift. And you could also look for some confluences on this side. So for example, I want to see an SMT, and those, in my opinion, are confluences that are enough to spot a reversal. Okay, so SMT, which is a crack in correlated pairs. So let's say EU and GU, so euro dollar and pound dollar. If one is taking a low and the other one is not taking that low, the same low, then that's an SMT. So I'll be looking for SMTs as well as a market structure shift in there. and then a creation of a fair value gap, because that's your zone of entry. Otherwise, you have no place to enter, or at least this is the easiest way to enter. So as soon as we see this in our intermediate time frame, then we could actually switch to the lower time frame and look for an entry from there. Two options at this point or at this stage. You either can take an entry based on the intermediate time frame, and therefore you can skip the third step. So basically this is an entry with no confirmation. So you're seeing, or you're using two time frames, higher and lower, and in between you're waiting just for that POI to create a fair value gap here and then enter from it immediately, and that's a valid one. But then there is another type where you can actually, by the way, this one, the no confirmation entry, is going to give you less reward to risk, but a lot of the time you're not going to miss trades. But then there is the entry on the lower time frame with a confirmation, and if you want to learn this, then you can go to the third step and we're going to go from there. But if you are taking no confirmation trade only based on the intermediate time frame, then you don't need to watch the third step. So for our third step, it's the entry confirmation, and that's going to be the lower time frame ones. So as we're having that intermediate time frame POI, so let's say it's a bearish one, and this is a POI that reacted from the high time frame, and you want to catch a big high reward to risk trade, then in that intermediate time frame POI, you look for a lower time frame confirmation. And there are a lot of types of lower time frame confirmation. One that is a risky one, but then you could definitely enter based on this, which is the change of state delivery. So let's imagine that price is printing bullish candles, and then the last bullish candle is violated with a closure. It creates an order block here, and that's why this is a valid entry here. So change of state delivery is violating the last bullish candle, and that's a bearish change of state delivery. Or if we're going lower actually, and we have last bullish candle here, and it's disrespected by a bullish candle, then that's a bullish change of state delivery. So we could enter on this, or we could look for the popular market section shift and fair value gap. So I'll wait for market section shift to happen here with the fair value gap, and I'll enter from that fair value gap. That's simply the 2022 mentorship model, right? Or another entry, and this one here, you could have taken on the intermediate time frame, right? So you could have taken this, or you could have taken this also. So all of those different confirmations, you could have done those not on the lower time frame. If you wanted to skip, you could have taken this here on the intermediate time frame. First, fair value gap. So as soon as we create a fair value gap reacting from that POI, we could have actually taken that lower time frame fair value gap. Now there are some other entry confirmation. There is the let's say the market section shift with an inducement. You see, taking that inducement, the first one, that's a continuity purge. You could have also look at the candle continuity theory, and that's the one that I came up with. So the moment that we create what? A swing high inside of that POI, we could look for the candle continuity theory, and make sure to watch my video about it. So just look up Mulham Trading Candle Continuity Theory, and you'll see how you can actually have a full trading plan just based on one candle. So those are the entry confirmation. That's the third step. We only have the fourth step, which is going to be the trade management, and is going to teach us how to actually enter the trade. What do we need to have in that trade? So for the trade management, as soon as you enter that trade, the first thing to do is identify your stop loss. Where do we have the stop loss? It's at the invalidation point. So the point or the zone or the whatever you call it, a level that if it's disrespected, then I don't want to be in the trade no more, and the trade is not valid no more. That's the level. So let's say in a fair value gap entry, if price closed with the displacement below that fair value gap, I don't want to be in the trade no more, because it looks like we're having an inverse fair value gap now, and there is a big potential that we could be going lower from now. So that's your invalidation point. A lot of the time in a 2022 mentorship model, for example, the invalidation would be the swing low or the swing high. Now it's different with every setup, so make sure to think about it, see what point or what is going to happen in order for me to have this idea as an invalid, right? Then we have the partial and break even. So those are two things at the same time, taking some partials on the trade and going break even at the point that we have a potential reversal or retracement. So let's say we're having some, significant highs and lows in a bullish example. When those highs are taken and there is a big potential that we could have a retracement or reversal from there, but there is another high that is above them that could also be taken, then I could go break even at that point and take some partials. In case that price decided to go higher, I'm still in the trade. In case price decided to just go lower and forget about the high that is above, then I'm out in a break even without no loss, right? And I've taken the partials already. In your take profit is going to be the completion of a market maker's models, so either buy model or sell model, and that's the external to internal or internal to external, and it's the high probability of reversal. So if I see a high or a low, that is a very high probability for price to react from or reverse from. So for example, a previous monthly high, previous daily high, or low, the same thing. So those high probability liquidity pools and very significant ones, I would have my take profit there. Why? Because price could just reverse from there immediately. So just to give a quick summary before going in the examples, we have 4 steps to follow here. The first one is looking at the framework, identifying the framework and what is happening on the higher time frame. And then we wait for a POI to be created on the intermediate time frame. And remember, not any fair value gap. And remember that not any POI is valid until we have some confluences, so including market section shift, SMTs, and liquidity sweep inside of that POI. Then we look for an entry confirmation on the low time frame, and I've went over several ones. Then we go into the trade management, and then finally we let the trade play out. Hopefully it goes to the take profit. Now we're going to go over some examples to ensure that the understanding is fully there. Without examples, without the live chart, we're not going to see nothing until we go to the chart and see some examples that played out previously on the previous days, previous weeks, whatever. But we're going to make sure that we look at examples that are valid, that some of the examples I've taken myself, and put this together on the best way. Starting with the first time frame alignment. So we're going to be trading based on the 4-hour, 15-minute, and 1-minute. And I'm going to take some trades only based on the 4-hour and then the 15 minutes. And sometime we're going to go down to the 1 minute just to explain everything in details, right? So what we see here is that on the 4-hour, and this is a trade that we took in the Discord together. So what we see is price going up, going to a fair value gap, and then started going lower. Now we broke below this low with a fair value gap. So this fair value gap is a high probability one, marking that fair value gap from here to here. There's also another fair value gap above here. So this is a potential fair value gap here. So we're going to be marking both of those, right? And those fair value gaps are high probability one in order to push his price lower again. So if the low is created here, price comes here, most likely is going to take the low because we are in a downtrend and prices come into internal. If we see a confirmation here, then most likely it's taking the external too. So playing the price action, we can see that price is approaching that. Now, one thing here to do when you have big fair value gaps, what you could do is look for overlapping. So for example, when looking at this fair value gap here, we can see that we have a big fair value gap, right? And overlapping is this low that is inside of the fair value gap. So now we are actually expecting the fair value gap to almost be fully filled. And you see price came here. Now you could do this all the time. So you see fair value gap here, or 2 consecutive or 3 actually fair value gaps. Where do we expect price to go? To this overlapping here. And that's where price almost goes to and started going higher. So the overlapping, and you see here, that's the same. So fair value gap, overlapping, that's where price comes, and again goes here because there's another overlapping here. So you see another overlapping here, that's where price comes. So one reaction from here, another reaction from here. So overlapping can actually minimize the fair value gap and give you high probability one. And you could also look at the Mulham Trading fair value gap theory, because it's going to also tell you where the real fair value gap is. But that's not something that I'm going to cover today. I have a full video on that. Today's video is only about the the trading plan and the time frame alignment. So we can see that we have actually overlapping here, and we also have this inverse fair value gap here. So that's most likely where price is going to react from. That's how I see it. So that's where I'm going to be looking for market section shift. Going back now to 15 minutes, because that's where I want to see my POI. I want to see POI created here, right? Or market section shift with a POI. So let's see, price is actually going higher, right? Not going to the fair value gap. There you go. So now go into that fair value gap. This is agent session. We don't trade here. And actually what we see is that this is your midnight open at this level. So we are above the midnight open. So we're most likely looking for sales. But then price goes to that inverse fair value gap and started going lower with no market section shift, and now go into the overlapping. And you see a lot of the time price doesn't come to the overlapping, but then goes back again. Let's say for this trade right here, you entered based on this change of state delivery with a stop loss somewhere in here, right? And then you target this low and then extend it more to the 4-hour structure. But we're going to take a look at that later. Now I'm waiting for the market section shift to happen, right? But let's say you entered based on this reason, actually it stopped you out here. So you got stopped out. That's the first time. And that's why I'll only take, change of state delivery at defined and refined areas, right? So I'm going to be looking at change of state delivery now because price hits that overlapping. But we're going to take a look at all different scenarios, okay? Actually, we got our change of state delivery here. So the real trade would be from here and stop loss above the candle high, right? And then we're going to target the same target, this one, the one below here. That's already 3.5 to 1. And we can actually extend it to the 4-hour. And we can see 4-hour, yes, right here. We can extend it to those lows below as well as this low here. And that's a 4 to 1. So a good one already. And we left some room for price to breathe above. So on the 15 minutes, that's what we have. Now, we could also take the entry based on the first fair value gap. So you see, we got actually no fair value gap here. As we're coming lower, no fair value gap. Almost created a fair value gap here, but nothing. Now we're going lower. Actually, there's a fair value gap here. So you could have taken a trade at this fair value gap here if it wants to be filled, but also looking at this market section shift here. So when we close below, there you go, that's a market section shift. And it looks like this fair value gap is not going to get filled. So the first setup that you could have taken is from this change of state delivery, only relying on 2 time frames. So 4-hour and then 15 minutes. You could have taken a trade based on the 15 minutes by itself, but we're going to also discuss how to take a trade based on the 1-minute time frame. So as we're coming lower, we see that there is no fair value gap here unless price decided to come to this fair value gap, right? That's the only one that I see after this market section shift right here. So that's your market section shift, the main one. And now we have this fair value gap here. So as we see, price is doing nothing. This is the agent session. So we started looking for trades here on the London and the New York. Price taking the Asian high, started going lower, and then a little bit deeper into, actually there was a very small, not a fair value gap here, but price came back to this order block right here, right? And left this fair value gap open. And we can see that we created a fair value gap here. So if price filled that fair value gap on the New York session, because the London session ended already. So if price comes to that fair value gap on the New York session, then we can take a trade from there on the 1-minute time frame. So going to 1-minute time frame, we can see that we have this fair value gap here, playing the price action. 7 a.m. is, so you see, price came to that fair value gap, but not on the London, the New York session actually. I'm gonna wait for New York session to start. There you go. It's starting here. So what we see inside of that fair value gap is that price before the New York session starts, it took the high here and then changes state delivery. So there's already a change of state delivery and filling that fair value gap here. So I could actually enter a trade from here already because there's already the change of state delivery and then fair value gap being filled. Stop loss, just above the fair value gap, somewhere in here. And what I could have targeted here is the first of all going to 15 minutes. Looking at the structure on the 15 minutes, could have targeted the Asian low, right? But that's not much. That's a 2.58. Now we can go to the 4-hour, which is our higher time frame, and look at what is happening in the 4-hour. We've taken a trade here, right? Based on the 4-hour, we could have targeted the 4-hour low, almost equal lows here. That's a 6 to 1. And then the other low right here, that's a 9 to 1. So that's a trade on the 1-minute, but based on the 50-minute and 4-hour structure. And playing the trade here, actually going to 50 minutes just to make it faster. So there you go. Price started going lower. And you have what? Also another fair value gap created here after price filling this 4-hour fair value gap. So another structure that is new. You could have taken a trade from here based on the 1-minute time frame. Price going lower, right? But this was not on the New York session. So mostly not taking a trade here. Price goes lower. Asian session. High of the Asian session is taken here. So another change of state delivery entry could be valid here. You see, there's one here, change of state delivery taken all the way to that target. And then you see price is continuing lower, but that's what we are going to be taking. So you see, that's not a valid entry because it's not in kill zone. This one is valid. It's taken the high with the direction of our 4-hour structure. And as we're coming lower, any high taken is a valid entry as long as, it's in premium or discount, in this case in premium. And it's a valid high that is taken. So you see this one, if we go back to 1-minute time frame, as we're taking that high of the Asian, what happened after immediately? So you see, taking the high, that's your last bullish candle, closing below here. And even if you don't want to enter based on this, enter on this displacement one, you could have, but this is a closure below, stop loss above the high. And then what we could have done is targeting the same target on the 4 hour. That's a huge one. And that's again the secret to high reward to risk. So back to 4 hour and take a look at what happened here. That's a huge trade based on the 4 hour structure. So something like this. That's a 14, almost 14 to 1. So that's what we do. And remember the 15-minute just by itself, it was something like this. 15-minute trade here, right? And then targeting the same target. There you go. That's a 5 to 1. So all of those trades just based on one POI on the higher time frame, we could look at it in different ways on the lower time frame. And now we're going to go over weekly and 4 hour setup. This is a setup that you can actually start using, and it's very simple, but you got to be careful when picking your fair value gap. So I want you first of all to follow all of the videos that I explain about the high probability fair value gaps. I also want you to apply my theory and perform the internal analysis inside of the fair value gap to know which part of the fair value gap should I take and which one is the real MAVG. Okay, so that's something that you could do. All what we're doing here is picking 2 time frames, 1 high probability fair value gaps on weekly, and first fair value gap with a market structure shift on the 4 hour time frame. So let's say I'm going to be picking fair value gap. So let's say this one here, because prior to this fair value gap, there was a liquidity sweep and then a PPR here. So a balanced price range also, and then a market structure shift. So this is a valid fair value gap. We also have this fair value gap right here because it also took liquidity and then a market structure shift in the lower time frame. And this one, you can see it aligns also with what? This high inside and order block. So order block here and a high inside. And also we have this one right here, fair value gap that has a liquidity inside. So taking a look at those 3 fair value gaps, I could take a lot more, but I don't want to explain what are high probability fair value gaps and go over this again and again because I already explained this concept a lot of times. So let's focus on this fair value gap for now and see how we can actually get a setup on this. So I'm going to use the replay mode and go here, and then we can go to this one and show you an easy model just going over 2 time frames. Okay, so a very easy model. You can also look for confluences like SMT and other confluences, the one you prefer. But the main thing is focusing on 2 time frames, weekly and 4 hour, and taking an entry from the first fair value gap after the market structure shift. I do prefer to say a market structure shift, but you can actually have this as an optional thing. So the first fair value gap that we see is this one right here, and we can actually that it has this overlapping here. So that's an overlapping of a low inside of the fair value gap. This is 4 hour time frame. It's a weekly fair value gap. Wait for price to go there. So price is hitting there. Actually, it touches that overlapping and you see a big expansion, price come into that fair value gap very aggressively. All I want to see now, so we can see that we had this liquidity sweep also. So there was a liquidity sweep inside. You could look for an SMT here. If, for example, this is your CAD, right? If I see pound CAD doing the opposite, creating a failure swing here, then that's an SMT. But for now, this is a liquidity sweep here. All I want to see is fair value gap to be created. And you see no fair value gap as of now. Another liquidity sweep. So you see the lack of a fair value gap is telling me something. It's telling me that price is not ready yet to go lower. So another liquidity sweep. And there you go. We have this fair value gap. So now feel free to either enter from 50% of the fair value gap or the beginning of fair value gap. It depends on your understanding of fair value gap. Sometimes price will retrace into 50%, sometimes not. So do some back testing, see how it goes. We're going to be entering from the beginning of the fair value gap. So let's say here, and what I'll be targeting is 4 hour structure. So I can target all the way there. That's a 6 to 1. I can target some other lows here, major lows. So for example, this one, 3 to 1. And I could go to weekly, right? I would switch to weekly and look at my structure here. So I could look at this low to be taken right here. So I could actually extend, if you go back to 4 hour, extend this to my weekly level. You could do this. So this is a weekly level. I could look for price to come here, but I'll make sure that price doesn't reverse from those internal fair value gaps, right? So playing the price action here, what I want to see is that, okay, price was going lower. So as soon as you hit 50% of this trade, and as you can see from here to here, that's 6 to 1. Actually, we already hit 3 to 1. So you're already taking 50% partials as well as going break even. If price goes back to your entry again, which almost does, right? And yeah, it goes to your entry. So you're out, you could re-enter, that's your choice. And then, eventually it goes to your take profit, but most likely it would be stopped at a break even here. Playing the price action more, we could see another creation of fair value gap, right? So it could actually look for also that fair value gap to be filled. So playing the price action here, you can see price going up, coming lower, close to that fair value gap, right? And all I want to see what is, you see, we are creating liquidity here also. And if I see that liquidity swept into that fair value gap, that's a high probability one. Back to 4-hour time frame, and we can see that price is starting to go lower. And there you go. So price is now going to that level, still not in the fair value gap. Went lower, still not in the fair value gap, right? Now it's into the fair value gap, and we can see that we have this high not taken, low, and all of this is inside of what? This range. So we took this low. Your market section shift, the main one is here. There is this internal one, which is this one, but I'm not going to take this one. You could have taken the trade from this low, and it's already out of kill zone. So this is already out of kill zone. I'm not trusting this fair value gap here. Could have taken this one with a stop loss below the low, but I don't know. I'm not feeling this one. I mean, if you perform the internal analysis here, you'll see that we have this liquidity level here, and this then we have the order block. So I would wait for price to actually go deeper into that fair value gap. And if you don't understand this, make sure to watch my video. So just look up Mulham Trading fair value gap theory, and you're gonna see that video. So I'm gonna skip this one, right? And there is no clear market section shift in this case. You see, we took the low. Now if price actually closes above this high, that's a market section shift. And price decided to go lower, lower, okay, lower into that liquidity level, and then closing above this high. So that's a market section shift for me now, and it's a displacement creating a fair value gap. So what we could do here is from this fair value gap, enter from here. Let's do maybe 50%, right? Stop loss below the low, which is this one. And now what we could do is on the 4-hour structure, we can see that we have this high and then this high. Those are some level of liquidity. We could have targeted also this high, but this is only 3-to-1. I'm gonna go to this high, switch to weekly time frame, and we can see that this is actually a weekly high in a fair value gap. So potentially price could actually go there. Now playing the price action here, what we can see happening is price a little bit near the price action, consolidating there, expansion going higher to that target. Now again, what we could do is this fair value gap, this is the part that was unfilled, and you guys know my theory on liquidity and fair value gaps and highs and lows inside. Back to 4-hour to see what is happening here. What we can see happening is that we actually reached that level. Let me actually remove this here. We actually reached that level, coming lower, but we have another overlapping PD array here. So we need to evaluate what to do. Also another overlapping here. But you know, what we see here inside is this liquidity level actually taken by this. And then we have a clear market section shift closing below this low. So because price did not return to this overlapping, what I could do is enter 0.5%. So let's say I'm risking 1% in all trades. I would risk 0.5% on this. And if price decided to go there, I'm going to enter. But just because this is a very clear changes to delivery, very clear market section shift and a fair value gap from a level that is good, then I'm going to enter from here. So could have entered here, stop loss here, above, right? And then what we could target is, actually we can see a lot of liquidity levels. We have this one, we have those equal lows inside the fair value gap, and eventually you got this low on the weekly time frame. This is where we entered from. But what I see is that this is a low that is very valid, and I can actually make my stop loss a little bit smaller. So what we see here is that, okay, price literally filled that fair value gap, right? And started going lower a little bit deeper into that level, right? So not stopped out yet. We go lower, and there you go, it hit the take profit and also started going lower. And you see, after taking that level, it started to shoot up almost to the entry and started going lower. So that was a level that is good to take profits from. And where did the price react from? So you see, what do we have? Those consecutive fair value gaps, right? But where did the price react from? See this overlapping high inside of that fair value gap? I believe that's where price reacted from. So you see, so that's why we need to keep attention to those. The same as we're taking sniper entries, we want to take sniper take profits. I really hope this video is helpful. You know, I could go over more examples, but it's not going to do nothing except making this video longer. I really want you to learn by yourself. Go to the chart, apply this. It's a very simple weekly to 4-hour fair value gap. You need to have those refined areas to enter from. Make sure to share this video with your friends. I really believe that I put a lot of effort into this, so I would like more people to learn from it. Like and comment is appreciated also. This is Mulham, and I'll see you in the next video.